Thanks for inviting me back, Keith. Just before the start of the long weekend, we have to kind of just let the juices flow a bit. So we're going to try and keep it nice and light.
Yep.
We're speaking about a practical topic today, which I have, experience in practice that not too many people have applied their minds, Keith. And today I'll just try to put some numbers to decisions and show you what the potential unintended consequences may be unless we actually have considered all the things that may happen after trustees have made a distribution. It's not as simple as just making a distribution. There's actually so much to think about, and that's the idea today. It's not just to tell you how you make distributions. I think we've seen many of those presentations today. Is just to what we need to think about. I always come from the perspective a trust in most instances is there for asset protection, point number one. So are we potentially undoing that benefit while we registered the trust in the first instance, or a generational wealth transfer tool? So are we keeping that in mind when we advise clients to save a lot of tax by just pushing everything out? I actually sat with an accountant this week and he said, what do I have to do? Just everything must be distributed because we pay less tax. And I said, please join the side session today and see, if I may potentially change your minds on some trusts.
I think I agree with that. Just as I said, I think as an income tax tool, it's not really very effective. I don't see it as an income tax savings device. It could be a good estate duty freezing device if you're talking about tax, but beyond that, it's really about planning and it's more about family asset protection and all of that. But that's agreed. And I think the way you've laid this out is it's complicated making these allocations and distributions. And what, the point is you've got to do this right. If you've done it wrong, you're going to have either a tax problem or you're going to have a fiduciary problem.
Yes.
But I agree with what you just said. So, yeah.
Okay, so let's shoot. So I think when you see these two income statements put next to one another, I'm sure when you look just at the bottom line, you'll clearly prefer one of the two. So I think most of you said this is the one that we trying to achieve, is to have zeros at the bottom of this income statement at the end of the year, so that we distribute everything out so that the trust does not pay any tax. So if we do that, look at what you've achieved. You only pay 280,000 Rand tax. And I've made a combination of income tax and capital gains tax. And here we've just distributed everything out so the tax is not payable in the trust. If you have, on the other hand, distributed or not distributed it out, you retain it in the trust, you can see there it hits us, especially on the capital gains tax, because it's literally half. So I've just taken top scales, 45. Obviously, if there's income splitting, we can get really fancy with distribution. So, it can get really complicated. So I've just taken it very simple, distributed to one person or retain it in the trust. And these are the taxes that you've paid. So there could be other benefits if we use income splitting, but then you'll see it actually creates more complication, and your paperwork is going to have to be, much more stringent and remembering what you've done. So my first question, if I was SARS, now we have to upload the distribution resolution together with the trust tax return, and this is the one SARS has been sitting and waiting for. And remember, if the only thing you remember today, do not backdate any more resolutions to your clients. SARS said they're going to employ AI. Remember last year at your conference, Keith?
Yeah.
So do not backdate. So I'm saying
that's a very common thing. Do not backdate. That I've been hearing for years. But I'm not sure if everybody follows that. And I think it's an easy way, as SARS gets tougher on this space, and clearly they intend to, I think people are going to have a lot of problems. Just to point in your fabulous trust here, I think the point, just to be clear for people, is that we're talking about trust income. You're trying to get, if you can, you don't want to be taxed in the trust. In the old days, you did because you got a preferential rate. But if you're taxed in the trust, you will have a penal rate.
Exactly.
So the point of getting the money out is to prevent the penal rate of the trust. To the extent that you're doing something else, it's about reallocation to members. So this is zero tax in the trust. It will fall somewhere else.
Exactly. Yeah.
That's it. I just want to
Well,
make sure for
will
viewers.
fall somewhere else. And I think while we
Right.
added that is the origin of the IT3Ts,
Yeah.
is it did not fall somewhere else in many instances with a 58 billion rand gap that SARS identified between how
Right.
much the trust distributed and how much actually ended up on trust tax returns. So yes, that is the idea, that the 218,000 was supposed to be ending up on a beneficiary's tax return. However, that in a lot of instances did not happen. The trustees and the accountant or the tax practitioner did not even speak to the beneficiaries for them to know that they had to include that in their tax returns, because most of the times done in retrospect. Like, we know trusts are 7 years behind on an average basis with their tax returns. So, the individual has long before that submitted their tax returns, and it's out of the way. But the principle is here. A lot of accountants strive to get their clients to a zero position in the trust as far as taxable income and capital gains are concerned. Now, I'm saying, if I was SARS, because they're not going to have the resolution, if you say we met on the 28th or 29th of February and we have distributed 1,234,567 rand, and we've distributed 8,811 rand income, I can guarantee you, if I was SARS, I would say, come closer. You are a genius, because how did you know midnight that the exact amount that you actually had in the trust to get it to zero, you could distribute? There's no way. We're waiting for investment statements. We're waiting for bank charges. We're waiting for all sorts of things to come through. Yes, you can be pretty close, but there's not a chance that your resolution can be 100% rand and cent. So remember your resolution wording. Do not have rand and cent unless you leave a little bit in the trust. I'm not even talking about the attribution rules yet. I'm just talking about distributions. So if there's zero, if I was SARS, I'll say, bring that resolution. You come and explain to me, how did you know to the cent how much you're going to distribute just to achieve zero taxes? Mindful of resolution wording. So yeah, unless you're a genius, there has to be at least a little bit left potentially in the trust. Then, have we by any chance ignored the attribution rules? Didn't we see those questions jumping out now in SARS's update on the income tax return? So SARS now wants to know. These attribution rules will now see, they've been around for a long time, and that's why I actually brought them in this discussion. Even though we are talking about distributions, it actually trumpets a distribution decision.
That's
so
right.
clearly, yeah, we assume a lot of these family trusts have been funded through loans, non-market related, interest-free. We know they've always been zero interest, 0% interest. So I can see here on the left-hand side, the attribution rules haven't been applied, right? Because otherwise you couldn't have distributed all the income and capital gains to the value of to the full value before taxes. Okay. The next question is, now that we've distributed the full amount out, because all that value now ended up in the hands of the beneficiary concerned. So, unintended consequence, we're undoing a little bit of estate planning and estate protection, because now we bleed it back into a beneficiary's hands. Now, just a note on this one, we know how long it takes, how difficult it is to just build value in a tax-friendly way in a trust. For example, Section 7C, all those, it makes it hard to get assets, paid up assets in a trust. So here we've just taken a beautiful growth in a trust, in the form of mostly a capital gain here, and we just bled it out to the individual straight away. So, and now it's exposed to creditors, because we'll see later on what the requirements of vesting is. Some trustees say, you know what, if somebody goes bankrupt, we'll just, undo the vesting as if the vesting never happened. That is not a vesting for tax purposes, because otherwise it'd be too easy. You can vest and unvest, vest and unvest, and then, really confuse SARS in terms of who's to be taxable on it. So yeah, exposure to creditors, big consideration. Careful to who you distribute. The in-laws become outlaws. We all know that story. Now, a lot of people haven't done this calculation. It stops with, we want zeros in the trust. And my accountant that I've spoken to this week, exactly the same argument. So you need to do a calculation. You can see already we need to figure out how much is exposed to creditors potentially. Now we're sitting with, if somebody dies today or the day after they receive the distribution, estate duty, 20% or 25%. I didn't even take the kind of the punitive one, the higher value one. So 200,000 you bleed to estate duty. People haven't thought about that. On top of that, executors fees, about 41 odd thousand rand. So
Mm,
just be very mindful. So we can see the extra costs now add up. So you've saved a little bit. We can see the
yeah,
two gray ones, but now the negatives are starting to pull in. So although we're saving about 229,000 in
mm,
taxes this year, we actually risk paying, just on this simple example, about 17,000 Rand more in death taxes and costs. Then I'm not even talking about the exposure to creditors. So can you see, and I'm always saying it's not always about taxes, and it's not always about taxes, how much I can save for this year.
yeah,
There's a broader horizon of taxes that I need to take into consideration, and then be careful of the further unintended consequences that we've spoken about,
yeah,
right? Now,
yeah,
remember, now that it's in back into individuals' hands, every generation there's going to be a state duty. So this thing is going to be bled over and over and over. If you try and get it back into a trust,
yeah.
Section 7C, most instances. So can you see how we're actually undoing a benefit of creating value in the trust, which is not created through funding, by a connected person in terms of Section 7C.
So
Okay.
just to clarify 2 points here, and just I'm trying to just say it very conceptually. I think too many accountants are focusing on the cash when they're not focusing on the allocation of taxable income.
Yeah.
And the two have to be the cash, which is really the trust return, the trust accounting return, because it's basically equivalent to cash. Um,
Absolutely.
so there's too much focus there, and you figure if you zero it from there, you're going to zero it from tax, but the two have nothing to do with each other. Your tax allocation, and you have to make two very separate statements. Is that just a fair synthesis of what the point is?
Yeah. Yeah.
Yeah.
Absolutely. Fully agree. So
And
now,
then just to be a little bit funny there, this just a question because there's an assumption here. Now, there is dad, let's just keep it simple. There's dad, mom, and the three kids. That's always the standard, right? And we'll
yeah,
be a little bit gender biased and say it's the dad who made money, especially in the older generation. We
yeah.
now see younger people like you are making the money. So let me know when you're available. I am single. So the point is the when you're looking at dad and mom, now they if they allocate it to their children, then it goes into their children's estate. So you have skip one generation or no more. But when I'm listening to you, how many times has dad allocated himself as a beneficiary where he's just basically putting it back? And when I'm listening to you, how often is that generally what's happening?
Absolutely. And remember now, the whole notion of Section 7C is going after growth in the trust that you actually capture
That's
there.
it.
So SARS wanted a way, and it's coming from the Davis Tax Committee, where they wanted a way to penetrate the trust growth or the value growth in the trust and
That's
tax
right.
that in the hands as if, that whole bigger value fell in your estate. So look
Yeah.
what happened in my example now. I bled
Exactly.
back the 1, 2, 3, 4. So there's zero growth. I mean, if it's not a value increasing asset, and property is not even a good bet anymore in South
Yeah,
Africa,
I know.
properties go backwards. So my loan is going to be 1 million. My value in the asset or in the trust is probably decreased, and I'm hitting Section 7C on
Yeah.
because I always explain Section 7. It's an assumed growth. So this
Yeah.
assumed growth now crystallized into this capital gain, but I just bled it out. So you're going to pay stupid on Section 7C, and you actually put the value back. So SARS has got a double whammy with
Yeah.
Section 7C and what you've done here.
Yeah, so I agree. Just to make it simple, so that if if the accountant is saying to himself, "Oh, dad is a beneficiary. I'm going to just give it back to dad." Yes, you have saved 229,000 in income tax,
Hmm.
but really that tax isn't really a savings because, well, you probably would have had that in your hands anyway. So if
exactly.
you're avoiding a penal tax
Mm.
in there,
Yeah,
again, because you're focusing on distribution versus the other. But then if you're putting it back in the state and you're giving it back to dad, you've accomplished nothing. You shouldn't have a trust there in the first place. I think
absolutely.
that's just, it's ridiculous to the children, maybe, because, but still you can't have any, it's just one generation. But if it's back to dad, this makes absolutely no sense whatsoever for all the reasons you said.
To give this advice. Now let's go on to the
Yeah. I,
multiple minor children, the 3 children, your example, because now we can use income splitting, we can become really
yeah,
fancy, and we can demonstrate to our clients, look what a favor we're doing you, because the capital gain, they can get that
yeah,
40,000 exclusion per
yeah,
person now. So wow, now you even save more tax, so my saving is even bigger
yeah,
now. Have you thought of, now we all know complicated families who got divorced,
yeah,
etc., the husband number 2 or wife number 2 or 3 or 4, and we are now sitting with a minor child who
yeah.
is younger than 16. Those people cannot have wills.
That's
So
right.
intestate succession. So good luck to you if you distribute, you vest. It's in their hands unconditionally, subject to the terms of the trust deed. You can't take it
Yeah,
back. When you get divorced, you can't say no, 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 things have changed, or let's uninvest it, or you know what, like people
yeah,
say, I can always get the value back from my children. No, 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 then it's a donation to you if you want the money back. Um,
yeah,
Now, children younger than 16, you run that risk. You get a beautiful income splitting advantage,
yeah,
but you can't have a will. And for people who do distribute to youngsters over the age of 16, please make sure there's a will in place, because it is a problem potentially if you die, as a child or a youngster or anybody else, and you don't even have a will. It may end up in completely incorrect hands, which is
yeah.
not something you want. Okay, so yeah, let's take this argument further. So if you now distribute, look
Yeah,
at this. We need real-time information. You remember Marking and said at the conference last year that you tell us trusts are run well. What is this, up in arms about that, you have to submit the IT3Ts May, September. Why does it make a difference? Because what are you doing the last day of February? On whose provisional tax return does it end up? So we need the correct information. We saw that resolution with, to the T, rand and cent that we distributed, which is impossible. Now you have to have that information. Most trusts are 7 years behind, so they don't have real-time information. So get a system that can give you proper
yeah,
information. You don't fall foul of these things. Then a little bit of a bummer, once you've made distributions, and I think a lot of people haven't kind of cottoned onto that, is once you've made a distribution, that amount, you need to check what in the trust deed, what the trustees are supposed to do, because it unconditionally vests, that any income, generated from that amount, you can't then pool it with your trust income the next year and just distribute it out again. That actually already belongs to the beneficiary concerned. So you
yes,
see in your accounting systems and your bookkeeping, you have to almost ring fence that. And how are you going to demonstrate to SARS if they say, right, this distribution must made in terms of the vesting rules, all income had to accrue back to the beneficiary automatically.
yeah,
There's no distributions. It's automatic. Show us in your bookkeeping how you actually tracked, income, for this specific individual. I think while we're on that, people said to me that even though Section 7C, unpaid distributions is excluded from Section 7C, SARS started asking questions. Why should we not apply Section 7C to unpaid distributions / loan accounts? They may have been credited to loan accounts. The trust deeds may still say we credited to loan accounts. Alternatively, that BPR 350 that SARS brought out on a capital gain that was an unpaid distribution, that it was one of the very clear requirements was you have to, all future income must be allocated to the beneficiary concerned. So be careful if you don't do that, because it may then start attracting Section 17. They may regard it as a loan. So can you see how complicated it is? It's just not, we're going to wipe it and, let's just stick and scrap the rest of the presentation. We want zeros at the bottom of the income statement. So yeah, so the compliance burden and the complication of your record keeping, the moment you start making distributions and it's unpaid, it sits there as an amount that you still owe to the beneficiary. Careful, how you do future calculations, because income generated on that amount has to automatically accrue to the beneficiary concerned. Okay,
Yeah.
so I think when we look at this, it's actually, in many instances, actually undoing a lot of the reasons, as you rightly say, why did you have trust in the first place if you just place it back into the person's hands? It's complicated enough with all these risks with the FATF and the fines and, the compliance burden around that. I think we may actually undo an entire estate plan.